deteriorating, especially on the lending side in terms of asset quality concerns rising. Kanchan Jain, CEO and Principal Managing Partner at Religare Credit Advisors, joins in with her perspective on things. And, Kanchan, you were part of the discussion. I'm sure you've heard the numbers out on PNB. Is the environment looking that tough on the ground in terms of asset quality, in terms of creditworthiness of corporates, not being able to service their loans?
Tanveer, I think the numbers that came out yesterday look obviously very positive, and I think for most people it's been surprising because the ground realities and what you see in some of the other numbers is very different. I think having said that, specifically with respect to bank NPAs, there is obviously a lot of stress in the system, but I think one of the things we have to realize is that most of the growth in the GDP is today being driven by the services sector. If you look at how that sort of contributes to bank credit to private sector in general, that's only about 25%. So vis-a-vis contribution to GDP, services is nearly 60%. However, for bank credit, it's only about 25%. Much of bank credit has gone to industry, and I think nearly 80% of credit to industry actually goes to the large sectors, which sort of incorporates all our infrastructures and the large sort of diversified conglomerates. So, you can see why on one side the bank assets reflect a lot of stress and very high level of NPAs, and that on the other side you have, GDP looking fairly strong. I think having said that, what was surprising from yesterday's numbers was the significant growth in the manufacturing sector, and that's a huge surprise given that it doesn't correlate with the IIP numbers that we've seen for October, December, and it doesn't correlate that well with ground realities as well. There's once again the noise of the new GDP series potentially having an upward bias to the figures for GVA, and I think if we were in the old methodology, we'll probably be in low sort of 6% numbers, and I think that would tie in much more what we see on the other data. I think what is concerning, however, and I think that sort of affects the outlook for the GDP growth over the next few quarters, is the GFCF, or the gross fixed capital formation, which is inching lower and now just about at 30% from the highs of about 36%. And I think that sort of is concerning because that sort of is going to drive growth in the GDP quarter on quarter over the next few quarters. So long as the services sector and urban consumption is sort of driving the demand, we should be ballpark in this sort of growth territory of about 7.5%. Some uptick potentially if we have a good monsoon, but I think really the biggest driver is going to be the investment cycle and how that changes for the economy. And I think the budget can do a lot there, so that would be one of the biggest things to watch out for.
All right, and Kanchan would like to know, in terms of your expectations from the RBI and in terms of rate cut, given the global as well as domestic growth concerns there, what are your expectations as far as rate cuts are concerned for the year 2016?
I think, clearly everybody is going to want to see what the budget comes out with. I would think there's a huge consensus on saying that the investment demand has to now come from the public sector. So I think contrary to what has happened over the last few decades where private sector has contributed a big portion, I think there is consensus that it's the public sector that needs to kickstart the investment cycle. Having said that, I think there is always limited flexibility in the hands of government given that there is the fiscal deficit to control. So there's going to have to be, I think, significant reforms on the revenue side, improvement of taxes, freeing up government resources from some of the business sectors and really using that to shore up the investment side. And I think so long as that's sort of on track and government expenditure is going towards more productive uses, that's going to drive GDP growth. I would think that you would see some easing coming during the year from RBI.
Okay. Kanchan, since you pointed out about the GDP trend, Eric Fishwick of CLSA says that this is an impressive achievement and would be more impressive still were the GDP statistics corroborated pretty much the bottom-up information, which is what you were talking about. As forecasters, we have no option but to take the last GDP figure as given, and on that basis, growth is likely to accelerate. The government's estimate of growth in the current fiscal is 7.6, which is above our expectation, suggesting some small upside from these levels. So, taking the government's estimates as a benchmark, Would you think that 7.5%, 8%, India can make an attempt at achieving those kind of growth rates for the course of the next 12 to 18 months, especially into FY17?
I think at if we have to go beyond the sort of 7% growth rates, and I think, we've had our finance minister talk about potentially hitting double-digit rates of growth, we need to see a significantly higher level of GFCF as a percentage of GDP. I mean, I think India itself was at about 36%, a few years back, and if you look at China, that number has been close to 50%, driving those high growth rates. So I think both structurally, we need to move up from the 32% that we've seen so far into 40% and beyond. And I think only then can we see significant growth in the GDP numbers. And again, as I said, given that the private sector right now is crippled with a high amount of leverage, government's got to step in big time and take up that investment, cycle up. I think in the absence of that, if we sort of hang around at the 30% level, it would be hard to cross, the 7.5% level of GDP growth.
Kanchan, we have to wrap up, so just 30 seconds for a quick closing comment. In your experience, are you seeing demand pick up on the credit side with a lot of these corporates? You speak to a lot of SMEs. Is there need for capital there and the need to invest?
I think humongous, would be the word. SME and mid-market accounts for just about 7-8% of bank credit, probably about 25% of GDP. I think to look at the kind of GFCF rates we've talked about, I think there's a requirement of about $250 billion of debt, which would mean a credit growth of about 25%. If you are at ballpark 10-11%, we're looking at 150 billion of debt required over the next few years to fill that gap. So huge need for private debt, private credit, and we've seen that pick up. You've seen a lot of large players come in and set up shop to do private credit. Huge asset class in US and Europe. So yes, there's a significant requirement of that. And it brings in new sources of capital in the form of insurance and pension funds, specialist managers, and I think, works out to be as one of the best forms of growth capital for mid-market. So I would say a big area for growth there.
Okay, and we wish you all the best with that. Thanks, Kanchan. Thanks very much for taking out the time to speak with us today. Big apology, a big sorry actually for keeping you waiting for the last 20 minutes as we had this breaking news come in for Punjab National Bank. But great you could take out time to speak with us today. We'll head into a break right now. There's not good news coming in from the banking space with PNB's very, very disappointing.